Hey everyone, me Kevin here, coming to you from Florence, home of the Medici family, and, well, Assassin's Creed 2. Climbed that building right there in that video game, which was epic. Anyway, ton of updates today we got to talk about. We got to talk about market valuations, capitulation, banks, consumers, multiple different stocks, including JPM, Tesla, Rivian, SoFi, Affirm. We'll also talk catalysts, which means we'll be talking about monkeypox and some of the crazy things happening this week. And, folks, you're in luck. Remember that this week you still have access to get lifetime access to the programs on Building Your Wealth for that discounted price before that huge price increase comes. We had to delay everything until the end of the month, and I apologize for that. It's my fault. But folks, if you want a complete download of my brain on everything from sales, YouTube, real estate, property management, not just me, but also Lauren in property management, my mother-in-law in property management, you get all this stuff. You can bundle this together. Link down below. Use the coupon code. And folks, you won't regret it. If you have any questions about bundling up, make sure to email me at kevin@meetkevin.com. We'll get you taken care of. And you also get access to live streams when I'm in the office. Although I've been trying to do some while traveling. It's a little harder. But you also get me in private live streams. So you can ask questions directly to me anytime they come up. And so what a lot of people do is when there are crazy times, they kind of just pop in like, hey, Kevin, got a question on this. And I can answer, which is cool because you get lifetime access to that as long as I do live streams. Okay, so let's get into the content. So first, let's talk about capitulation and market valuation. So consumer staples were supposed to be safe havens, right? Obviously not. We know staples have gotten wrecked. We saw what happened with Walmart. We saw what's happened with Target, which is kind of a blend of staples and discretionaries. I personally think it's more of a staple, but anyway, we knew that discretionaries were going to get wrecked, and they have. But what's crazy is retail keeps buying. Like literally every time one of these companies falls, retail buys. In fact, when we look at capitulation, we've got a few numbers to look at right now. First of all, retail is diamond handing overall, while systematic funds, mutual funds, and hedge funds are liquidating. Systematic, these are sort of your economic prognosticators, the people kind of like me in January, like, oh crap, things are about to get a whole lot worse before they get better. Then you get sort of mutual funds. Generally, they tend to follow hedge funds. We talked about this in our last video. Mutual funds tend to follow hedge funds, and all of them have essentially started lowering their positions to equities. So, retail, however, instead continues to buy the dip. Target and Walmart specifically heavily at the end of last week. How about, though, in terms of which of the two, folks, twice as much buying in Target by retail compared to Walmart. Goldman Sachs, in addition to Vandatrack, both are reiterating that retail are the ones diamond handing and actually buying the dips. Goldman Sachs came out with this figure that $100, for every $100 that went into stocks the last 74 weeks, only $2 ended up flowing out of stocks. And they say this is specifically because retail capitulation is really low. In my opinion, honestly, I'm kind of proud of this because this is like really awesome. Now, I know it's been a really difficult period in the stock market, but I mean, think about it. That means people aren't making the mistake that everybody used to make during every kind of crash, which was panic and just sell and never get back in. The hardest problem, the most difficult thing for people who sell is buying back in. They almost never do. This is why in January when I sold, I said I will be back within 60 days. So, hey, I avoided $6 million in losses. I was able to make a few bucks, It was good. That doesn't mean I'm not hurting now, right? But the point is, like, getting in and staying in, so important for most folks. And really, the stats are showing that retail's doing a really good job at this. Obviously, hedgies and everything, they're dumping on us, and it sucks. But take a look at this. If you need some motivation for buying, right now, put-call ratio, lowest level we have seen in 2 years. That means call volume is exceeding puts right now by more than 2x. This tends to happen before big bullish reversals. Fingers crossed, though, that might just be hopium. At the same time, though, listen to this. Forward multiples for the S&P 500, your forward price-to-earnings ratio, forward 12 months for the SPX, S&P 500, is sitting at 16.4. The 5-year average for the S&P 500 forward 12-month PE ratio is actually 18.6, so we're substantially under the 5-year average. And get this, the 10-year average is 16.9, which we're also below at 16.4, which is really incredible. Really shows you that valuations are actually great. I'm happy about this. I mean, to me, it just continues to reiterate that this is the time to buy. But folks, we got to talk about some stocks here as well. We got to talk JPM, Affirm, SoFi. We got to talk Tesla. We got a bunch of other news to talk about. In other news, things that moved the markets today. First, we heard that Starbucks will officially be joining McDonald's and leaving Russia permanently. No franchises, no businesses. See ya. Also, we had word from Joe Biden that the United States might consider getting involved in defending Taiwan against China, implying that the United States military would get involved. The White House later clarified that no, what Joe Biden actually meant was that we would just send weapons to support Taiwan if they needed to, because remember, there are two kind of versions of the One China policy. This is not to be confused with the One Child policy, which expired. This is the One China policy. One China policy is the policy in which China believes there is only one China and only one official regime that can regulate both China and Taiwan. Obviously, Taiwan seeks its independence, and the U.S. has its own One China policy, and it technically is a rule of ambiguity, where we're like, we're just going to stay out of this, but we respect and, we'll support Taiwan. So we don't really officially recognize anything, so it's kind of like, yeah, One China. Taiwan, keep doing you, man. More power to you. We'll send you weapons. It's like, okay, come on, Biden. At least get your story straight when you're going to talk to us. Speaking of which, Biden's approval ratings, lowest levels that we have seen in his entire administration. We're now at 57% disapprove. This is up from 53% just last month. Not so great, but don't worry, Congress isn't doing that great either. 48% of Americans distrust Congress to actually help them through this inflationary disaster that we have going on right now. Biden has also commented on potentially changing the China tariff rules. These were tariffs that were imposed by Donald Trump, and lifting those could be good news for certainly chip supplies and excess pricing on shipments between China and the United States, which could be good for bringing down some of those inflationary pressures. Probably something they might want to consider doing before midterms. Anyway, China is also working to stabilize their economy. China is now offering $21 billion in tax relief to companies and consumers to try to stabilize the economy. In other words, they're making it rain with money to stimulate things again because they screwed things up when they rug pulled the real estate market last August, which really hit everyone pretty hard. November and December, especially the whole Evergrande crisis. We've also, this by the way now follows, of course, the lowering of lending rates for real estate last week, and now creating a model for refinances just this week here in China for real estate properties. On the baby formula shortage, before we get into some individual company updates, a plane loaded with 70,000 pounds of baby formula landed in the United States. Biden says this should address about 15% of the nation's needs for baby formula. But boy, oh boy, what a crappy situation to be in, especially since a lot of parents are now resorting to trying to make their own do-it-yourself formula. Yikes. I don't like hearing that. We used formula as well. It's not every woman can produce enough milk naturally, and so it's like, well, there are reasons we need baby formula. It's kind of crazy, though, that it's gotten to this. You'd think the government would be a little more proactive. I know 70,000 pounds sounds like a lot, but, we need more than 15% supply. All right, let's get to some specific stocks. Specifically, Tesla. Tesla plans to restore production at its Shanghai plant finally to pre-COVID levels, and actually above pre-COVID levels. This is really good, especially since we've been waiting for Tesla to get back to these levels of production. They expect to be back to 2,600 vehicles per day by Tuesday, which is tomorrow. This is big because, again, we have been at a substantially miserable level of vehicle production. We've been we've only sold 1,512 electric vehicles in China in April, which is terrible. That's down from 65,000 the prior month. And we've probably only gotten about 8,000 to 16,000 vehicles out of China, when usually we're producing somewhere around 2,200 per day. And that's now attempted to be getting pushed to 2,600 by Tuesday. So it'll be nice to see that production come back to Tesla, since the stock has come under substantial pressure, not only because of this, but the Elon drama with Twitter, now harassment claims. Which, by the way, is an interesting note that was circulating. That's like, why is it that... It's kind of ridiculous, but why is it that for 25 years Elon Musk has had a blemish-free record of, any kind of sexual assault allegations, and all of a sudden they say the day or within 24 hours of him announcing that he's going to start voting Republican, oh, that's it. Now all of a sudden he's a sexual predator. Twitter drama, though. I don't know. All right. So anyway, then we've also got news that Giga Berlin is adding a second shift. This is pretty incredible. On top of the fact that Tesla is also hiring more researchers in Giga Shanghai. This is despite all the shutdowns. They're still going to invest heavily in Giga Shanghai. And so the Giga Berlin one is pretty neat though as well, because Giga Berlin's only been open now for 2 months. And so after 2 months now, we're already seeing the second shift get added. Usually when you get facilities at full capacity, you try to get to 3 shifts. So right now we have a 7 a.m. to 3 p.m. shift, and they're just now opening the 3 p.m. to 11 p.m. shift. Again, the first one being 7 a.m. to 3 p.m. Now they're opening the 3 p.m. to 11 p.m. Only 2 months after the opening. It's honestly quite impressive, and the hope is that Giga Berlin and Giga Austin can ramp a little quicker to where hopefully by the end of the year we could still be on track for that 1.5 million vehicles of production, maybe even slightly more, as Elon Musk has alluded to. So we'll see. It'd be great to have that 60% year-over-year growth, because Tesla's PEG ratio looking so juicy right now. I mean, it's under 1 if you believe that Tesla can hit the 60% growth. All right, this car's getting loud. I don't know what they just turned on that darn thing. And I don't think it's the engine. It's some other motor in there. Oh, well, we'll just keep going here. So, banks. Oh, man, we got to talk about JPM. So, JPM had a really big discussion, investor day presentation. And Jamie Dimon, the CEO, a lot of people hold a lot of respect for him. He came out and said, hey, there are a lot of storm clouds right now facing our economy. But one of the things to know is that clouds can disappear. And when clouds dissipate, we're actually in a pretty strong economy. I kind of liked that analogy, because he's right. Like, there's so much freaking fear. There's so much saying, oh, no, that's it. Inflation's not going to go down. Inflation's going to be entrenched forever. I don't know, man. The bond market's not saying that. The 5-year break-evens are down to 2.9. 10-year Treasury is at, 2.84. Big deal. I expect that to sit around probably under 3.25, but probably somewhere between 3 and 3.25, which we know that's going to be bad for the real estate market, which will be bad for individuals' wealth. But in terms of these storm clouds of inflation, I don't know. I'm pretty optimistic that the inflation is going to go down, and I'll give you why. This is not just my gut. Right now, we've got commodities experts talking to Bloomberg substantially this morning about starting to see commodity supply outweigh demand. That's going to lead prices to come down. Morgan Stanley released more research this morning. This is all consistent, by the way, with the earnings reports that we're seeing, whether it's from Tesla or from Walmart or Kohl's or whatever. We continue to see reports that inventory levels for consumer goods are substantially skyrocketing. Morgan Stanley released a report just this morning showing that real inventory levels for consumer goods are now well above average levels and have started spiking the beginning of this year. So in other words, impact here, Kathy Wood might be right. We could actually see a substantial buildup of inventories, which will lead to price reductions, which we're already starting to see, especially in apparel. We'll probably start seeing it in things like computers, and actually we've already started seeing price reductions in computers based on CPI, but we'll probably see those more broad-based, as well as TVs and other really just consumer discretionary goods. Let's try to get people spending again. This is literally what is confirmed not only in the research reports, but used car prices, earnings reports, you name it, which is good, because if we can finally actually and meaningfully get inflation to come down, we're going to walk into the craziest bull market, because we're going to have the most efficient companies ever, plus low inflation. I mean, consider this. JPM said that their bank productivity is now up 20%. This is something that we've been talking, and this is compared to 2019. This is something I've been talking about since the pandemic started. The pandemic is the greatest weeding force that we've ever had. The pandemic allowed businesses to fire tons of people, just hire back the best people, and now you have another sort of tightening period where it's like, oh no, okay, we did overhire a little bit, let's just do layoffs again, as you're seeing it sort of like Amazon now suggesting they're going to lease out extra warehouse space and not hire as many people because they don't have as much demand. But the point is, you could keep the most efficient people, right? And so you have these two cycles, the cycle of the pandemic shock and now the inflationary shock, where you're getting this massive filtering effect for these companies that all at the same time are becoming substantially more efficient with their supply chains and their processes for making money. Like, this is not the time to bet against America. This is the time to bet on America. And I'm so confident we're going to look back in years and we're going to be like, damn, I wish I bought the dip every fracking day. Of course, then you get all the people in the comments and stuff, you catching a falling knife. Oh, see, I told you to sell. You shouldn't have bought back in. Ooh, somebody got impatient. Man, everybody's a freaking keyboard moron. The comments. Actually, there are a lot of you that leave really cool comments that are really nice and supportive, but some of them are just so jaded. So jaded. But anyway, What else do we have? Oh, so this is interesting. So JPM is launching Pay in 4 for debit cards soon. This is a really cool contrast to what we've been seeing in the credit industry, which is just basically people getting into buy now, pay later for credit cards and debt, right? But now offering that for debit cards, kind of cool. PayPal's been doing this with credit cards. Expanding it to debit cards by Chase, I think, is really smart. It's still different from what a firm does. And I think this is a very important reminder that if you're investing in a firm, one of the things... Oh, look, there's Lauren. Hey, Lauren, you want to be in my video? She's just walking over. No, she doesn't want to be in my video. Anyway, one of the things to remember with a firm is that you're in it. One of the things to remember with a firm is they have a lot of merchant partnerships, tons of merchant partnerships. This is what makes them special, to where rather than just doing buy now, pay later in 4, you're doing it in over the time of 12 months to 24 months to 36 months, and that's what makes the buy now, pay later services, in my opinion, actually valuable. Because if you think about it, pay in 4 weeks, I mean, sometimes I think some companies are starting to do 4 months, but if it's pay in 4 weeks, that's basically no different than just buying something on a credit card and then just not paying your bill for 6 weeks, because it takes usually about an average of 2 weeks for the bill to come due, or for the billing cycle to end, and then you have 30 days to pay it, right? I mean, that's kind of like buy now, pay later, if you think about it. So anyway, that's JPM. They're also hiring thousands of... So in other words, do I really think that's a huge burn catalyst for a firm? Not really, but I do think that some investors who don't understand that difference for a firm are not going to like that announcement. So it could be something that weighs on a firm. Something that does weigh on another fintech more, I do think, though, is what JPM is doing to compete with SoFi. So they're now going to hire thousands of wealth advisors, up to 6,000 by 2025. This is more than they previously expected. And in my opinion, this is two things. One, it's an opportunity for you to get a job. I mean, think about it. Like, if you need a job, become a wealth advisor. What do? Just go pass your Series 65, or go find out what JPM is hiring for, and go pass the stupid Series license test. It's not that freaking hard. It'll take you like 2 months of study to do it, and then boom, you're good. So then you can get a job if you wanted to, work your way up at JPM, and if you can become an investment banker, geez, you can make some big money. I met some investment bankers, and they're making like 7 figures a year in investment banking. No guarantees, but I'm just saying, like, there are huge opportunities. But this is, in my opinion, a direct attack on SoFi. SoFi, remember, is a company that has wealth advising services built into all the things they do. I mean, they do ETFs, they do the stock platform. I think they've got crypto involved in there as well. They do the student loans, the home loans. They do so many different things, and wealth advising is one of them, because they're trying to provide everything that banks are doing. And JPM's like, oh, no, we don't see any competition from fintechs yet. They don't provide all the stuff that we provide. Meanwhile, it's like, I don't know, JPM, it looks to me like y'all getting nervous. You seeing the competition heat up. So now they're trying to attract that talent, right? Anyway, I think it's smart by JPM, and their prices have come down, or their stock prices come down so much. I mean, I think their book value is like $80, and they're like, what, 125 or something like that? It's no surprise they're up like 6% today. It's not for me to invest in. I'm not a big fan of investing in banks, but I think there can be money. There's money to be made. There's money to be made basically buying anything at this point in the market, I think. But anyway, the Federal Reserve also released a document showing that deposit growth for consumer savings has kind of flattened. This is kind of in contrast with JPM's earnings call a couple months ago, actually probably more like 6 weeks ago, when they were saying that, we still expect bank balances to go up this year. So we'll see if that does end up slowing. That could be a little bit of a red flag. Some people are pissed that Lagarde isn't hiking rates high enough at the European Central Bank. She wants to go for 2 25 basis point hikes. People want more than this. We'll see what happens here and how that affects us in the United States. More important, though, is Bullard. That's our sort of perma-hawk. He's come out and now suggested he wants to get the not only to above neutral, which we've been talking about last week, priced in being somewhere between 2.75 to 3.25. Bullard wants to get to 3.5. If we got to get to 3.5, market still has to price in some more pain. So that's a little bit of a problem. Speaking about pain, Peter Lynch had a brilliant quote. He says, I'm just going to paraphrase it here. He basically complained that people spend hours and hours of doing research on like what microwave to buy, but when it comes to doing research on their investments, they won't spend a lot of time at all. And in fact, they oftentimes refuse to spend money for advice, and they end up spending too little time researching and actually understanding what it is that they're investing in. And so that is something that Peter Lynch says is one of the biggest mistakes, is that it's very important important to research. And one of the things we talk about with course members is that one of the reasons we do substantial research on companies that we're investing in is because when we go through difficult periods of time, we feel we know them better than other people. And that's not to try to brag or be right. It actually just gives us the confidence to get through the FUD. So when we hear the FUD, we're like, no. We know that FUD is actually fake news, not just FUD, because it doesn't matter. Like, here's the actual truth, right? The more research you do on a company, the more confident you can be of that. And so research is very important. Which, by the way, you don't want to be penny wise, pound foolish. If you still have not taken the download of my brain or anything that you can learn from me in the links down below, seriously, consider doing it. Look at it. You want to email me for a bundle code. You can bundle. The bundles are there. You could scroll down on the meetkevin.teachable.com website. You can scroll down, look at all the bundles. But if you have more questions or whatever, just shoot over an email, kevin@meetkevin.com. All right, what else do we have? We talked about inflation. Oh, yeah, Rivian and monkeypox. Okay, so Rivian. The suits are starting to suggest that Rivian may end up seeing a lot of cancellations as individuals kind of stop going all in on maybe more speculative or newer EV brands. Now, I thought this was a really interesting argument, and it's one that I had not considered before, but I kind of think about it now that would I want to make a bet on a newer company right now? Like, remember, I bought a Lucid. I bought that for my father-in-law. But that was also in a very bull market, right? This was like in October or November or whatever we bought the car. Market was doing really, really well then. And the reason it's nice to buy a newer car in a bull market, and I don't advocate buying cars either, it was just a gift. But anyway, the reason you might want to buy from a startup in a bull market is because they could just raise more money and they can continue to make sure their customer service is great and their R&D is great. But sorry. But choking to myself here. But if you go into a recession and all of a sudden they have to cut back on R&D, they have to cut back on customer service, or they face a bankruptcy risk, well, crap, now you're potentially stuck with a newer car and potentially a lack of customer service or less R&D or less future development, at least in the near term, for technologies like full self-driving or whatever, right? And so that's a bummer. So basically the note of the suits is like, oh yeah, during a recession, people might actually be less likely to speculate on purchasing a car from a newer brand, like again a Rivian, because of those fears, the fears that they may not get the customer service or the other benefits that they're seeking in the future because of recessionary times. And so that might lead to more cancellations, which would then also hurt, it kind of turns into like a self-fulfilling cycle, because then people cancel, then the company has less money, and then the company has less money, and then they actually can't do anything, right? It's like the self-fulfilling recession. Anyway, I thought that was really interesting and somewhat of a downside risk for the smaller EV companies, whether that's Neo, Lucid, Rivian, whatever. But then again, the market's already so low, it's like, really, how much more can we go? Regarding monkeypox, the EU Health Administration says the risk of this spreading widely in the general population is very low. There's a lot of talk going around about airborne transmission for this and the possibility that this virus can survive in the air for up to 90 hours. A lot of research right now seems to contradict this and says that maybe, but the odds of you actually getting sick from the airborne transmission of monkeypox is extremely low. That monkeypox is something that is much more transmissible through bodily fluids or close contact with other individuals. Excuse me. Not so much from airborne transmission, which I think that's the last thing we want to hear about right now is airborne transmission of anything. Tired of wearing masks. All right, then. Catalysts to watch this upcoming week. Here are some of them. So Zoom and Xpeng report earnings today. The Atlanta Fed president speaks at some point today. We get minutes from the FOMC on Wednesday. And I'll pay attention for that. Really, I think the big hints we're looking for is where are they going to go? Are we going to go to 2.75? Are we going to go to 3.25, 3.5? Remember, the market's really been pricing in somewhere between 2.75 and like 3-ish. So we'll see. If we end up needing to go higher than that, I think the market will end up having some pain. Although hopefully we end up getting a bullish Fed U-turn once inflation actually meaningfully starts coming down. My guess sometime between September and October or November. Pay attention to COVID cases in China. Obviously, the lockdowns in China are something that's definitely weighing on our markets. Numbers for U.S. new home sales come out on Tuesday. U.S. GDP and initial jobless claims come out on Thursday. This will be an estimate for Q2 GDP, so that'll be interesting to see. University of Michigan consumer sentiment on Friday. Obviously, pay attention to monkeypox and capitulation, but otherwise, folks, there you have it. Thanks so much for watching the video. Check out public link down below. Check out the programs on Building Your Wealth, and email if you have questions regarding those bundles. Remember, you get lifetime access to all the new content in the programs as well. We've got a bunch of new content coming back as well when I get back to the office. Thanks so much, folks, and we'll see you in the next one. Bye.